Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Garrett DeSimone, Head of Quant at OptionMetrics, to discuss the impact of earnings, the economy, and global events on options volatility and how our current environment compares to historical data from past recessions. Garrett, it's great to have you with us. Welcome to Trade Talks.
Hi, Jill. Thanks for having me.
First, I want to discuss volatility on a higher level and the impact it has with earnings announcements, economic data, and other market-moving headlines. Why is it so susceptible to those kinds of things?
Sure. So from a very broad level, implied volatility is a measure extracted from the options market, which gives us a sense of how nervous or the future price movements in the underlying security are going to be going forward. What we know about this is there's earnings information and macroeconomic uncertainty are also embedded in implied volatility. So before a big earnings announcement, we'll typically see a run up in implied volatility, or before an FOMC announcement. It's because investors are pricing a larger than normal move in the underlying security.
And this is helpful even if you're only trading equities, because you can learn a lot from what implied volatility can tell you in terms of what that move might look like, whether it's on a percentage basis or a dollar basis. It's another clue into your work.
That's correct, Jill. So typically when we see implied volatility spike, going forward, we'll also see associated higher vol in the underlying equities. So this is where the VIX comes from. It's a measure of the fear index, which also tells us going forward how much risk of movements investors are pricing in ahead of certain announcements.
Now, current volatility, let's take a look at that in comparison to some of the historical data that you've provided.
So if you look at this chart, Jill, right now we're about at a neutral level when comparing implied vol versus historical vol. This measure of implied vol versus historical vol is also referenced in quant circles as the variance risk premium. And we look at the variance risk premium as an indicator of the profitability of short volatility trades. So typically an investor that has a short vol position, such as a straddle or a delta neutral straddle, will gain compensation when the premium is positive. In other words, implied vol typically trades above historical realized vol. However, there's several situations where we see where historical vol actually shoots way higher than implied vol. And in these situations, short vol trades become serious losers.
All right, now the current economic situation in the US, that looks like it varies a bit from past recessions as well when we take a look at this next slide.
Yeah, absolutely. So if we compare it to four other situations where the VRP, or the variance risk premium, or the difference between implied vol and historical vol, became largely negative, in the following quarter, returns never posted positive values. This rally is really extraordinary in the sense that we've had such a negative value of variance risk, and which is typically seen as financial institutions undergoing large systematic stress. And we've seen an incredible rally following up to that. This could also provide some insight into why the retail market is outperforming these funds, because a lot of these funds use the variance risk premium as an indicator to engage in short volatility trades or go longer in the market.
Yeah, that's interesting. And a lot of your work focuses on the quantitative side of the business. So this is an interesting question that I love to ask quants. It almost seems like if everyone's using the same kind of model, and that retail investors aren't using this kind of content, it really is interesting to see the divergence in terms of their performance and their results with what's happening right now.
Yeah, precisely, Jill. And the other issue is, retail investors are not subject to the risk constraints or meeting the quarterly benchmarks that institutional investors are. And I think part of this is also linked to the incredibly high level of the VIX, even during this rally. So the VIX has been over 30, but we've seen equities rally over 30% over the last several months, which is a very interesting contrast, because typically you would see the VIX return to a longer term normal around 18.
Do you think that suggests that there will be more volatility and more uncertainty in the market to see both volatility and equities moving at the same time? Because as you mentioned, they typically move inverse of each other. So it sounds as if this rally may not be trusted.
I agree with that 100%. And I think if this was really a sustainable rally, we would have seen that volatility returns relationship you just mentioned, return to normal. But I think there's a lot of nervousness amongst investors whether this is going to be sustained. And in terms of volatility being a measurement, we also we believe in volatility, or implied vol embeds things about information about macro fundamentals. I think the biggest fundamental indicator we have here is the virus count moving forward, and that's what's keeping investors nervous.
Yep, I'd agree with you there, Garrett. Thanks so much for joining me on Trade Talks.
Thank you for having me, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.